Hey guys, this is Terry with Futures IO. It is my honor to welcome back Ernie Chan for today's webinar on understanding risk management. The bullet points for today's webinar are computing and understanding the risk exposures of a trading strategy within a factor module network, Kelly optimal leverage and its pitfall, constant proportion portfolio insurance, diversification, optimal capital allocation, minimal variance portfolio, risk parity portfolio, and their pitfalls. Now, please feel free to type your questions into the questions box during the webinar, and we'll do our best to answer them at the end of the event. And if you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. Don't forget that you can also follow us on Twitter, Facebook, and YouTube at Futures IO. And without further delay, I'll hand it over to Ernie.
Thanks very much, Terry. And let me make sure that my screen is visible to everyone.
Yep, looks good.
Great, thank you. Yes, thanks everyone for coming to my webinar today. My name is Ernest Chan, and for those who don't know about me, I started out as a researcher in machine learning at IBM TJ Watson Lab, and then I entered into the financial world starting at Morgan Stanley, followed by prop trading job at Credit Suisse and various other hedge funds. Presently, I'm a principal of QTS Capital Management, which manages a hedge fund as well as various separately managed client accounts. On the side, I have been an author of various trading books. The most recent one that is actually coming out in January 24th is called Machine Trading, Deploying Computer Algorithms to Conquer the Markets. As well, I am a adjunct faculty at in Northwestern University in Chicago, teaching risk analytics, as well as supervising student thesis in finance and trading. So the first thing I would look at to assess whether how a strategy would behave, to measure the riskiness of a strategy is actually to look at it in a factor model framework, and that's what are the those are the so-called risk factors. What are risk factors? Well, we can ask a number of questions. It's actually very intuitive to a trader. You can look at your strategy's returns, perhaps daily returns, and check whether they correlate with, for example, the stock index return, the bond market's return, whether it correlate with change in realized volatility or the change in implied volatility. Now, you might be a bit surprised why I differentiate between realized and implied volatility, and it so turns out that they are not the same. If you have followed my my blog or some of my discussions in various conferences, you will realize that I'm quite adamant in distinguishing between the two, because some strategy might correlate negatively to realized volatility, but they could well correlate positively with implied volatility. They do not vary in the same manner. But we'll leave that aside for now. And you might also ask if your strategy correlate with small cap stocks, whether small cap outperform large cap. Now, this is a very well-known factor, SMB factor in risk factor models, and it's actually quite relevant recently. So if you look at the performance of a lot of stocks since the presidential election, you will see that small cap outperform large cap. Now, does your strategy, perhaps an equity strategy, does it perform as well? Does it have positive return? If not, you might find that your strategy actually has a negative correlation with the outperformance of small caps. Similarly, if we look back in time to the dot-com bubble, before the bubble burst in 2000, value stocks have greatly underperformed growth stocks during the bubble. So if your trading strategy in your back test also had negative return in those bubble period, you can say that you have a risk factor which correlate with the outperformance of value stocks, because at that time value stocks certainly have a negative performance relative to growth stock, and your strategy might load similarly. And then finally, you might look at whether your strategy correlate with the momentum factor, WML, which is a common name for it. That is to say, if the market recently, if you find that most things that perform well recently continue to perform well, you might call that you are in a momentum regime. And if your model is actually a mean reverting model, you might find that you correlate negatively with momentum. So there are multiple ways to analyze the risk of the strategy, how it correlates with these kind of well-known factors, and whether it's correlate positively or negatively. So you might ask, okay, so what if we can find out these? What can we do about it? Well, what you can do about it is that the idea is that a portfolio should ideally be neutral to all these factors. That is to say, it should have zero correlation, or another term for this correlation is exposure or loading to any of the above. If you manage to create such an ideal portfolio or ideal strategy, we can call it a pure arbitrage strategy. It's pure alpha. Now, this pure alpha is an ideal that most traders would love to get, but unless you are a high-frequency trader, you probably won't be able to achieve that, at least not with just one single strategy. Your strategy is likely to suffer under some circumstance. That is to say, likely will have non-zero correlation to some risk factor, and it's not a completely pure alpha that you're generating. However, we don't have to all turn into HFT in order to come close to that ideal. It is possible to construct pairs of strategies with opposite signs of exposure to come close to a risk-neutral portfolio. Now, what is the that's not a really a new or surprising or profound concept, because people have been doing that all the time, or for many years. This is, for example, if you're combining a long portfolio with a short portfolio, you have most likely neutralized the exposure to the equity index, right? It would be a market neutral portfolio. More advanced is that if you are combining a mean reverting portfolio, mean reverting strategy with a momentum strategy, most likely you will be forming a volatility neutral portfolio. Note that I say it is volatility neutral. I didn't say it's Vega neutral. Vega neutral means that it's neutral to change in implied volatility. I'm talking about this combination will be neutral with respect to changes in realized volatility. So I'm calling it volatility neutral. Okay, so finally, if you really are interested in a Vega neutral portfolio, you will have to combine options, because really only option portfolio have implied volatility. So you might look into a trading strategy called dispersion trading, where you buy stock option strangles and short stock index option strangle. That would create a Vega neutral portfolio. So now, of course, a market neutral portfolio is only neutral to market risk. It is not neutral to volatility risk, is not neutral to momentum risk, and so forth. So therefore, just combining one pair of strategy is not sufficient. That's why I say you need to combine multiple pairs of strategies. One pair might be neutralizing exposure to market, another pair might be neutralizing exposure to momentum. But it has net positive correlation to the market. So you need to diversify with respect to these pairs in addition to forming pairs. So that's diversification is something that's always good, but we will talk about it at the later part of this webinar. So leaving aside the risk factors for a moment, one important concept that we have to bear in mind is that despite this best construction that you can come up with, no matter how beautiful theoretically you can construct a risk-neutral portfolio, past risk neutrality is not guaranteed for, it's not indicative of future risk neutrality. That's just always true in investment finance. Past performance is not indicative of future performance, and also past risk neutrality is not indicative of future risk neutrality. So, you can only do your best in approximating, neutralizing historical risk, but you can never, of course, eliminate future risk. And so one of the most important concepts in risk management is controlling your leverage, because we know that if we are able to eliminate all future risks, you can have as large as leverage as you like, no worries. But the fact that you can't really eliminate future risk, controlling leverage is becoming a most important risk management measure. And a lot of you might know that I'm a big fan of Kelly optimal leverage, using the mean divided by the variance of the return, the mean of returns divided by the variance of return. That's the kind of the maximum leverage that you should ever apply to a strategy or portfolio. Now, theoretically, again, we go back to theory land, is that if the returns have a true Gaussian distribution, leveraging a portfolio at the Kelly leverage F will never lead to ruin. That's a mathematical result. You can prove it mathematically. By ruin, of course, we mean that your net asset value goes to zero. Okay, but and the beauty about this Kelly leverage is that it's mathematically proven that if the returns are Gaussian, you will never lose enough money to lead to ruin. But that doesn't give us much comfort, because real returns, as everybody knows, are not really Gaussian. In fact, they have very far from Gaussian. They have fat tails. A good, quick, real-life example to show you that Kelly leverage doesn't really protect you from ruin is to look at the S&P 500 index. If you look at the historical return of S&P 500 index and calculate the Kelly optimal leverage, it's going to be about 5 over the last 30 years. If you create, if you're holding a portfolio that basically, if you're holding the index portfolio, the index portfolio that tracks the S&P 500 index, and you lever it at 5 times, supposedly you're going to get the maximum return. But in reality, on Black Monday 1987, the return of that portfolio will be minus 20% unlevered. If you're levering it at 5 times based on Kelly optimal leverage, of course, you're going to get 100% loss. So it does lead to ruin, despite the theory that if you are levering it at the Kelly optimal leverage, it will never lead to ruin. In reality, it will lead to ruin on that particular day. Why? Because a minus 20% return is never predicted by Gaussian return. It's just an infinitesimal probability based on the Gaussian return. But of course, the Gaussian, the SPX return is not Gaussian. That's why it causes this problem. As a result, most people only use half of that. To be on the safe side, we, typically, if Kelly advises you that the optimal leverage is 5, we should only be used at most 2.5 leverage to protect us from the tail end of the distribution, the non-Gaussian nature of returns, as well as to protect us from the errors in the estimating returns and variance of returns, right? Because the optimal leverage, of course, it has to be estimated for, is computed from estimates of mean and variance of returns, and any estimate will of course have errors in them. So to protect us against these two issues, we would only use half carry. But even if returns are completely Gaussian, there's another problem with carry formula is that we are not just interested in preventing ruin. Oftentimes as trader or as investment managers, we are given a maximum drawdown that is not 100%. We might be allowed to only lose 50% for a client or for ourselves. So, telling people that, oh, I wouldn't lose more than 100% is not much of a comfort to a lot of investors. So, what if I only want to lose 50% of the account? Well, that can still be done within the carry framework, but you have to include a concept called constant proportion portfolio insurance, and I have written about it some years ago in a blog post that you can reference. But let me give a quick summary of what this CPPI is. CPPI simply asks you to divide your account, or your equity to be precise, into a safe account and a risky account. The allocation to the risky account is based on the maximum drawdown that you are allowed. For example, if you have a $1 equity and you are allowed a maximum drawdown of 20%, then you would allocate 80 cents in the safe account and 20 cents in the risky account. So the 20 cents is the maximum that you can lose. And you would only trade, take or hold risky investments in the risky account. And as you trade or as the investment accrue profit or loss, you will apply carry leverage to that account. That is, you will increase or decrease your holdings in that account so that it will always be equal to the carry leverage. So based on this theory that if you are applying carry leverage, it would not lead to ruin, or if you apply half carry leverage, would not lead to ruin, the risky account would always be positive, or at most zero. But even if by some bad luck it actually goes down to zero, you would still be protected because your 80 cents is in the safe account, and you are only reaching the maximum drawdown of 20% in the overall account. Now, so what do we do as you accrue P&L in the risky account? If after one period you are profitable, then you would rebalance capital between the safe and risky account. Again, if it's profitable, that means that your net asset value, overall net asset value has increased. You will then divide that again into 20/80 and keep 80% of that new net asset value in the safe account and only trade the 20% of the net asset value. So for example, if after one period the equity in the risky account goes up to 25% of the total equity, you would need to move the cash to the safe accounts to restore it to 20% of the total equity. Now, what happens if it is not profitable? If your trading strategy is not profitable after one period, you do nothing. You do not move money from the risky account to, you do not move money from the safe account to the risky account, because if you do that, you will be able to lose more than 20%. That's not advisable. So, of course, by moving money and keeping the leverage the same, what you are doing is you are adjusting the order size based on the changing equity in the risky account. So what you ultimately have to change is the order size. If you lose money, you will lower your order size. If you make money, you increase your order size, while always keeping the carry leverage, keeping the leverage equal to the carry leverage, but changing the equity in the account to make sure that you will never lose more than the maximum drawdown allowed. Okay, so that sounds pretty good. Who doesn't like to make sure that we don't have a drawdown greater than whatever percent we are comfortable with? But that has an embedded assumption as well, and that's one of the major pitfall of CPPI as well. It is that you are assuming that the risky account can never go to zero, or it could not get below zero. Go to zero is still okay, because going to zero, you ruin the risky account, but you still have your 80% of your safe account, right? So you're still maintaining your maximum drawdown allowance. But the problem is oftentimes in a highly levered portfolio, a account equity can go negative. When it goes negative, if your brokerage account net equity value goes negative, what happens? Well, if it goes negative and the owner of that account is a limited liability entity, you can just declare that entity to be bankrupt, and then you will still be protected. So in that sense, if the owner of a brokerage account is a limited liability entity, no worries. Your risky account indeed has a floor, which is the NAV equals zero. So CPPI is valid in that case. But if the account owner is a person, that creates big problem. Because if you're a person, you will have to declare personal bankruptcy. That's not a good thing, right? You don't want to declare personal bankruptcy just because one of these risky accounts goes to negative equity. And that happened actually for many accounts who traded Swiss franc in January 2015. Because of the unpacking of the Swiss National Bank in 2015, the Euro Swiss franc exchange rate dropped 29% in one day. And of course, many forex traders are highly levered, so you just have to lever more than 3.3 times to get negative equity in a forex account. And what happened? Well, what happened is that a lot of some brokers did go out of business, and even those brokers that did not go out of business, for example, Interactive Brokers have many customers. FX account went underwater, and what did they do? They don't just eat their loss. The broker will pursue account owner to recover loss. And so unless you are owning that account using a limited liability vehicle, you will be personally liable to the negative equity. That's a very unpleasant scenario in trading. So let's move on. As I said earlier, one of the key, besides controlling leverage, the other key pillar of risk management is diversification. Another term for that is a proper capital allocation to these diversified pairs of strategies. Right? First, we pair up the strategy to neutralize whatever factor risk that they have, and then we add many pairs so that they continue to, they have a better chance of neutralizing each other's remaining factor risk. So the question becomes, how do you allocate capital to all these different strategies, pairs of strategies or pairs of stocks or portfolio of stocks? Well, of course, there's this is a well-studied problem in classical finance, but there is a simple way to understand it. Again, the way to understand capital allocation is through Kelly formula. It turns out that Kelly formula is not applicable only to just one asset, where F equals to M divided by variance, return divided by variance. If you have n different assets, the Kelly capital allocation formula is the analogous F equals to the inverse of the covariance matrix of returns times the matrix of expected return. So you can see that this formula in the single asset case reduces to our old Kelly formula. But in the multiple asset case, this is a very nice and simple formula that tells you how to allocate assets. Right? It's just matrix multiplication, the inverse of the covariance matrix times the expected return factor. That's it. This formula tells you both the relative asset allocation across the n assets, as well as the absolute leverage that you should apply to each strategy. So it does both job at once. Pretty simple. The proof, of course, is maybe a little bit hairy, and Of course, we're not going to go through it. But what's interesting about this Kelly portfolio allocation formula is that it is identical, or well, not identical, but it is consistent with what Markowitz mean variance portfolio optimization would recommend. They are proportional. So if Markowitz portfolio optimization recommend the tangency portfolio, which is, if you remember some of your studies of classical finance, the tangency portfolio of a Markowitz portfolio optimization scheme is the portfolio which has the maximum Sharpe ratio. Okay, it's the portfolio with the maximum Sharpe ratio. And that's also what the Kelly portfolio allocation formula will recommend. So basically, it will generate the maximum Sharpe ratio for this allocation, this portfolio. It maximizes the compound. If you adopt this formula of asset allocation of the tangencies portfolio, it will maximize both the growth rate of your portfolio as well as the Sharpe ratio. So it does a lot of things at the same time. It's all good as long as you adopt this formula. It's all good, again, in theory, but in practice, past performance is no guarantee of future performance. So past returns of the stocks are different from the future returns of stock in both their mean and their covariance. So whatever is optimal in the past may not be optimal out of sample. That's well known. And however, that's more true of the expected returns than covariance of returns. Covariance returns is actually more predictable. And therefore, a lot of, in more recent years, people have moved away from this mean variance optimization because the mean part of the mean variance portfolio is so unstable, it's useless to optimize the mean. Whatever mean that you found in the past is going to be very different from the mean in the future. So what's the point of doing mean variance optimization? However, the variance part is better. Whatever you calculate as the past variance of a portfolio likely won't be too different from the future variance of the portfolio. And furthermore, as Professor Andrew Ng wrote in his textbook on asset management that I cited here, the estimates of the mean do not improve with larger sample size. So even if you have a 30-year of back test, it doesn't make it any more robust, this mean variance optimization. However, the estimate of the covariance does improve with larger sample size. So if you have a longer back test, your estimate of the variance will improve. Now, whether it's predictive of future is a different matter, but at least as an estimate of the past, the error bar does decreases. So because of these kind of consideration, in recent years, portfolio managers have tend to prefer minimum variance portfolio than the Markowitz optimal mean variance portfolio. They would rather minimize the volatility of a portfolio than to maximize the risk. Than to maximize the return, because they figure the return is unpredictable. We can't really just use asset allocation to maximize return. The best we can do is to minimize the volatility of a portfolio. In other words, we can use the covariance matrix of the assets to predict what the overall volatility of a portfolio, and we minimize that, and that's the best we can do. That's what is called minimum variance portfolio. But there's a bonus. It is not only because it is more stable. It's not only because covariance is more stable that we prefer a minimum variance portfolio, but it is also interesting that low volatility stocks tend to outperform high volatility stocks. Now, of course, this only applies to stock portfolio. So far, whatever I've said so far are applicable not only to stock portfolio, but to portfolio of anything, to portfolio of Forex, to portfolio of futures, and even to portfolios of strategies, right? Not even an asset portfolio of strategies. But right now, this particular sentence, this particular item, bullet point, is only applicable to stocks. Research has shown that low volatility stocks outperform high volatility stocks out of sample. The out of sample part is the crucial part, right? If you are looking backward, that doesn't mean much, right? you can easily pick stocks that have high return and high volatility. But the question is, based on a historical sample, can you predict what stock is going to outperform out of sample? Well, it turns out that volatility is one good way to make this out of sample prediction. You can look up this paper that I cited for the result. And so because of these two reasons, number one, that covariance is more stable than return, and number two, that low volatility stocks outperform high volatility stocks. So in the last 20 years, investors have increasingly moved over, favored minimum variance portfolio than contingency portfolio. They forget about maximizing return. Just disregard all expectation of return. Okay, just focus on minimizing volatility. And so you have a lot of these ETF called minimum variance ETFs. I gave you 3 examples here that adhere to that philosophy. Now, going one step further, some investors distrust even the covariance calculation because they don't think that correlation is stable enough. They reduce the whole portfolio to an uncorrelated collection of strategies or stocks. Okay, assume that all correlation is 0. That's a most extreme view of the out-of-sample predictability. They think that the only thing that's really predictable is individuals' component volatility, not even the correlation of their return, not to mention the expected return. But even the correlation of return are error-prone, they feel. And so that leads us to what's called the risk parity portfolio, which is all the rage in the most recent few years. Risk parity portfolio is simply saying that the capital allocated to each strategy or each stock S is just inverse, proportional to the inverse of this volatility. Cliff Asness has an article on risk parity portfolio. You can just Google Asness 2012 to read about it. One example ETF that implement that risk parity portfolio is SPLV. And of course, the famous Bridgewater Associates all-weather fund is also implemented largely on the principle of risk parity. Now, everything that I said has a pitfall. So, every theory in finance has its pitfall, essentially. That pretty much captures the spirit of today. So what's the pitfall of a risk parity portfolio? The pitfall of a risk parity portfolio is that it is prone to start a contagion, to start a stampede. So when the market becomes volatile, every risk parity portfolio, those multi-billion-dollar funds or ETF, will be deleveraging. Because remember, allocation is proportional to 1 over volatility. So volatility increases, allocation decreases. Everybody is simultaneously deleveraging. It actually increases the volatility of the underlying. So it gets into a vicious circle. This is what is meant by contagion, because a lot of these portfolio hold similar asset. As long as one big fund is deleveraging due to market volatility, everybody has to start deleveraging, and this vicious circle actually causes a stampede, or what's called the contagion. And that is what's supposed to happen in fall 2015, when this risk parity portfolio all-weather fund lost 7%. So nothing is perfect. Everything has its pitfall. Now, finally, so what can we do? Basically, if everything has pitfall, I would say that this last slide, I haven't thought of a pitfall yet. Maybe you can. But for me, volatility per se is not risk. So what if your portfolio one day up 10%, one day down 10%? It doesn't matter, right? I mean, unless you have to, somebody force you to sell, liquidate your portfolio when it's down 10%. Otherwise, you just hold on to it. So volatility to me is not big deal. It's not risk. In fact, I like volatility. What I dislike is tail risk, where the portfolio can drop 90%. If it's drop 10% is okay, but if it drop 90%, chances are I'm levered. right? If I'm levered, even in the drop 9%, I'll be right out. So we don't like tail risk, but we are okay with volatility. So what really matters to me, to a strategy or to a portfolio, is the maximum drawdown, not the volatility. And so I believe that maximum drawdown is a better measure of tail risk than volatility. Or you can, of course, measure tail risk using the classical financial measures such as value at risk, like what's the probability that you will lose 90% of the portfolio, that sort of numbers, that value at risk, or expected shortfall, which is a sort of a loss-rated value at risk, which you can look up in textbook. But all these measures, similar to maximum drawdown, which I think is easiest for a trader to understand, is that it measures tail risk much better, tail events much better than volatility. And so I personally prefer a kind of a modified risk parity where the capital allocated to each strategy is not inversely proportional to its volatility, but inversely proportional to its maximum drawdown. So that's kind of my takeaway for today. In the face of all kinds of different pitfalls, it just kind of distilled to this one last statement. So thank you very much. I'm looking forward to more questions. I don't want to outstay my welcome, but just a bit of advertisement. I am going to teach my annual option course this weekend and the next weekend. This is a course that's offered only once a year, so please feel free to sign up. Actually, there are not too many spaces left. But otherwise, please keep in touch through my Twitter feed, and as well as make comments on my blog if you like. Thank you very, very much for coming, and I should open the floor for some questions if you have.
Okay. If you have any questions, please type them into the questions box at this time, and I will ask them to Ernie. Well, it looks like there might not be any questions.
Okay, great.
I'll give them another minute or two. Maybe they're typing. Oh, here we go. In reply to Kelly leverage of non-normal assets, have you tried to derive the formula for, say, students' T distribution of returns, or tried Monte Carlo simulation?
Monte Carlo simulation is certainly a good way to derive optimal leverage. If your underlying distribution is very non-normal. I have not tried to derive it using the student T, but I have tried using Monte Carlo simulation. Actually, that was mentioned in my second book as well. So I actually had a Monte Carlo methodology that was laid out using for that purpose. However, the problem with Monte Carlo simulation is that you have to have a parametric distribution of return, right? So you still have to fit your actual return to a model distribution. Otherwise, you can't simulate Monte Carlo. You simulate any time series. So whether that time series, that simulated time series actually capture the real historical return is a different matter. Yeah.
Okay.
So it suffers on some limitation. Is similar to the Gaussian, but it's of course better.
Okay. Will your new book include any Python code, or is it just MATLAB?
No, I am will not include Python. The idea. I have actually talked about it in a previous Futures.io workshop. The code is secondary. The strategy is and the concepts are the most important. But in terms of implementation, we have my researcher actually is a Python coder, but I have found that it is much more productive to backtest in MATLAB than in Python. That, of course, has some, it's a bit of a subjectivity there, but given that MATLAB is only $150, I don't see why I should sacrifice productivity for a small fee. So that's why I'm continuing to use MATLAB, because I personally view it as the most productive strategy development platform.
Okay. Is the 1 over max drawdown simply 1 over the percentage or a dollar value?
Okay. So there is a no, it's percentage. That's for sure. Yeah, everything is in percentage, because we have to, the same capital allocation is applicable whether you have a $1 million account or whether it's a $1,000 account. So I cannot say that the maximum drawdown has to be, $1,000 if one has only got 1,000 equity in the account.
Okay. Can you say something more about your new book and how it differs from the previous ones?
Well, actually you can go to Amazon.com and browse through the book. It has is already available on Amazon, and you can look at the table of content, and you will find many chapters that are that talk about topics that are either completely ignored in my previous book, for example, machine learning techniques or options strategies, or time series analysis, namely Rimmer models, Gauge models, and so stuff, which are completely ignored, or that were touched on in my previous book, such as Kalman filter, but it is now discussed in a much more satisfactory way within the larger context of state space model. I will explain why it is much better to determine the parameters of Kalman filter within the state space model framework than to just simply use brute force backtest optimization to find the initial parameters of a Kalman filter. So I would say that this last book is one notch more advanced than my previous two books. It is, it covers a much wider variety of asset class and much more advanced trade, statistical mathematical techniques. And it has a long chapter on market microstructure that is also completely not covered in my previous book. So there's a quite detailed look in particular on the US stock market microstructure, which I think is quite important if you want to optimize your execution if you trade stocks. And actually also if you trade futures. There are quite some nuances about, for example, trading calendar spread that I myself was not familiar with, but I learned from the masters themselves, and I relay their knowledge in the chapter on market microstructure, how to trade futures, and what is meant, for example, by implied quotes will be discussed in the new book. So everything is much more advanced and much more comprehensive treatment in this new book.
Okay. Should you use the observed max drawdown or a multiple of it just to be safe, e.g. 2 times max drawdown?
See, if you multiply max drawdown by 2 for every strategy, you get back to the same capital allocation. So the real question is, what is the overall leverage that one should apply to a portfolio? So there's a question of asset allocation, and there's a question of the overall leverage of portfolio. So the asset allocation problem is unaffected by whether you use half max drawdown or 1/3 or so forth, but certainly it affects the overall leverage of the portfolio. And that is a fudge factor, I'm afraid to say. I do not believe that one should be so conservative as to say that I multiply a factor of 2 to expect a real maximum drawdown is 2 times what's observed historically. I think that it is okay to trust your historical backtest maximum drawdown as long as it's incorporated some financial crisis. So for example, if your backtest include 2008, that might be sufficient to assess what's the worst case scenario is, and using that historical maximum drawdown to determine your maximum leverage would be okay.
Okay. And these are going to be the last two questions. Let's see. I'm trying to figure out how to word this. Can Kelly be used when you have many operations at once, like stocks or options positions at once?
Yes. The Kelly formula, only input is the return, the unlevered return. I should be very clear. It's the unlevered return, and the that's it. And then you can compute the expected return, the mean of the unlevered return, and the standard deviation or the variance of the unlevered return, and that gives you the Kelly leverage. So the return can be, one return can be that of an option portfolio. The other could be a future instrument, and the third return might be a stock. So you can mix and match anything and compute the overall asset allocation that you should apply to each one. So it could be very, very heterogeneous. No restriction on that.
Okay. And then the last question is, if max drawdown is 100%, does that mean one should allocate 1% of the portfolio, or is there an error?
If the maximum drawdown of a strategy is 100%, well, you have to decide how much a maximum drawdown you can tolerate, right? So that's a number. It's the discretionary number. Let's say you are interested in only losing half of your account equity in the worst case. Then, of course, if the maximum drawdown of a portfolio is 100%, you should only leverage 0.5 times in order to restrict your loss to 50%. So there is a discretionary element, which is what is your risk tolerance? How much are you willing to lose, right, in terms of equity?
Okay. That is it for the questions. Thank you for the webinar and the wealth of information today, Ernie. As always, it's been a pleasure.
Great to be back, and have a good trading week, everybody.
You too. Thank you.
Bye-bye.